Hey guys, Cody Sperber, the Clever Investor here. Welcome to my YouTube channel. I'm super excited that you're here. Today we're going to be talking about Opendoor, the iBuyer, and we're going to be talking about if they're going to see the same fate as a company like Carvana. Are they going to go bankrupt? Is their stock going to go to zero? Let's talk about it. On the surface, these two companies and their stories, they look really similar. We've all lived this story. The pandemic and other economic factors caused a massive surge in demand for some markets like homes and cars. Now that inflation and interest rates have cooled demand, companies that offer these products like Opendoor and Carvana, they're finding themselves with too much stock that isn't worth nearly as much as it was early in the year. And stock prices that are gradually, or not so gradually, dropping to almost nothing. So is Opendoor experiencing the same struggles with debt and price pressures as Carvana? Are they suffering from managerial missteps like Carvana? Let's take a closer look at Opendoor. So check this out. By the way, if you like this video, smash the like button for me. Share this with other real estate investors. It's going to help my channel, but more importantly, it's going to help educate people on what's really going on with iBuyers out there. So look, since 2014, Opendoor, they were kind of revolutionizing the way people buy and sell homes. Opendoor, as you probably know, is a digital platform for residential real estate. Like Carvana, they seek to cut out unnecessary steps of the buying and selling process. They want to make things simpler for everybody. Now, Opendoor, for example, buys homes from sellers. They do some minor repairs and they resell the homes on the open market. But unlike flippers that buy low and sell high, Opendoor has a fee-based business model. They give competitive offers, and I say that with quotes because by the time all the fees aren't in there, they're not really competitive, but they give competitive offers for a house. They then take a service charge out of the sale proceeds, similar kind of how a real estate agent gets a commission on a traditional sale. And according to their website, the service charge typically falls between 5 to 8% and goes at most to 14%. The service charge varies on how long they expect it's going to take for the house to actually come out the other end and sell, so that way they have funds to cover costs like maintenance, utilities, and taxes. But you probably heard about the problems with Carvana. Carvana stock drastically dropped when news about debt restructuring came out, and it pretty much left the equity worthless and possibly is going to lead to bankruptcy. The stock suffered a massive 30% loss in a single day, and it just keeps dropping. At the beginning of January 2022, Carvana stock was like $240. Now it's under $3.72. Yes, you heard that right, $3.72. And the stock only trended in one direction since March, and that's down. So as we see how low Carvana stock could go, many people are starting to think about Opendoor doing the same thing next. And it makes sense for people to believe that. After all, home prices, they're flattening out. Some markets, they're actually falling. Inflation's making everything cost a lot more. Mortgage interest rates are at all-time highs, 40-year highs, making home ownership completely unaffordable and out of reach for a lot of Americans. A lot of people have decided to wait it out, sit on the sidelines. Hopefully, just in the future, things get more affordable, or at least less outrageous. Now, just case in point, in Q2, Opendoor reported 5% of their homes were on the market for 120 days or less. By Q4, the number has increased to 21%. Part of this is a sign of the times, but Opendoor also reduced their inventory, which would skew these numbers. So is Opendoor doomed? It may not be as terrible as people may want you to think it is. Let's look at some key facts that they might actually fare better than the ill-fated Carvana. First, let's talk about earnings reports. Nobody really anticipated much great news for Q3. In fact, expectations for their revenue was between $2.2 billion and $2.6 billion, half of what it was from the previous quarter. But they actually did better than expected, and they reported a $3.4 billion revenue. So they had a massive jump in the right direction, 48% up from the previous year. That's great news, right? Well, not exactly great. They took a hit to get those numbers. They sold more homes, but they also slashed some of their home selling prices, so they lost money on a lot of those homes. So even though they brought in more revenue, they lost money on the inventory that they had, especially the ones that they had since Q2 or longer. And they still have some of those pre-Q2 homes in their inventory that they need to sell. And the longer they hold on to those, the prices are going to continue to fall and they're going to lose more and more money. So they want to get rid of these homes quickly. They want to cut their losses. Then they're not going to have to worry about homes with lower spreads collecting dust in their pool of inventory. The newer inventory, which hopefully have better spreads, will hopefully help their bottom line in the future. Now, they forecasted revenues between $2.3 billion and $2.5 billion for Q4, and that's traditionally a tough time for home sales. Now, of course, these revenue numbers will depend on a couple of factors. The first factor is how many pre-Q2 homes that they're actually going to sell in a pretty quiet market. They expect to sell 65% of their older inventory, and that means that there's still going to be some of their homes in their portfolio that they're going to have to take massive losses on, okay, net losses, once they eventually do sell. Now, the next factor is how much home prices actually dip over the next few months. If they sell a good chunk of their inventory, they may see increase in revenue, but their EBITDA is essentially getting destroyed. Now, EBITDA is the earnings before interest, taxes, depreciation, and amortization. Now, in the past quarterly report, the management team conservatively wrote off, listen to this, $573 million for inventory valuation adjustments. Now, this is a projection the company has to make to recognize losses. The adjustment is going to align with homes that they expect to generate realized gains as the older inventory is sold. So the losses don't seem as bad, but it's still pretty bad. They estimate that their EBITDA is going to be negative $125 to $175 million. But because they sold more homes to get rid of the older inventory faster, the EBITDA was more like negative $211 million. So Q4 is not going to do them any favors. Those numbers should be coming out here soon. And with EBITDA expected to between negative $335 to $355 million, they're expecting more bad news to contribute to these Q4 numbers, and the news is just going to pull the stock price down. All right, still, they've been extremely conservative with their numbers in hopes of the bad times happen in 2002. They write everything off. They get rid of all their old inventory. They get out ahead of the curve. They cut operating expenses to around $45 million, and they increase the spreads of all their newly acquired homes. So things might not be looking bad unless home prices continue to drop more than expected. But with Opendoor offering less for the properties they're trying to buy in order to improve their spread, they're going to get a lot more pushback from potential customers, probably buy a lot less properties. And look, given the current market trends, in a time where many potential buyers are probably just going to sit on the sidelines and wait the inflation storm out, a lot of sellers are just not going to be happy to sell their homes, period, let alone to Opendoor. And then there's also Opendoor's new product, their third-party business, and it allows Opendoor to be like a middleman. They're almost like wholesaling now. They're like a marketing company. They're generating leads and they're pairing buyers and sellers together, right? And Opendoor is involved in the transaction as almost like a marketing company, and they charge their fees, but now the consumers can transact directly with each other. So buyers and sellers are just using Opendoor as a technology platform to connect together. All right. Now Opendoor won't have to own the property. So they're trying to evolve with the times, but we shall see, right? These direct transactions make the process and properties move a lot faster compared to maybe selling your house on the traditional MLS. Now, there are a lot of steps in the potential delays in selling traditionally, so it could be a situation where technology helps everybody win. Sellers get their homes sold quicker, buyers have more inventory to choose from. Opendoor doesn't need to purchase properties. They still get the opportunity to sell it. They're connecting buyers and sellers. Everybody's kind of winning in the transaction. It seems like a good play. Now, Opendoor aims for 30% of their total transactions to come from this new strategy. But will people continue to choose Opendoor to buy and sell their houses? Will the fee be worth it compared to going a traditional route? We will see. Now, finally, we have to take a look at just some numbers. Does Opendoor have any money to get through a tough market? Will they survive the pain? The capital is still pretty solid. As of the end of September, they had $11.8 billion in borrowing capacity with 70% committed. The company also was sitting on $1.5 billion in cash and cash equivalent and $1.5 billion in equity in properties. Furthermore, they're planning on financing $349 million to buy more homes. So will the capital last? Is really going to depend on the market. If home prices continue to drop more than expected, it could actually spell a lot of trouble for Opendoor. Now, another thing to keep in mind or keep an eye on is their contribution margins. Now, this is a measure of profitability from various properties based on the variable cost associated with those properties. In the last couple of years, Opendoor's contribution margins have been around 4 to 6%. This past quarter, unfortunately, was nowhere near that number. It was negative 0.7%. So this is another thing we pay attention to. But with the organizational changes, the hope that Q4 is the bottoming out period, and the hope that home prices don't take another drastic dip, Opendoor is actually expecting to be 3.5% in the long term, and they even have some more optimistic hopes of getting up to 9%. Of course, if they're not getting the response that they want for their current spreads, they may have to increase their buy prices, and then their margins are going to get a lot tighter. So here we go. Let's answer the question at the beginning of this video. Is Opendoor going to become a disaster like a Carvana? Well, with a little bit of luck, in the housing market not, getting worse, and with the new CEO, Carrie Wheeler, at the company helm, hopefully making better management decisions, Opendoor might not go that way, even if in a tough housing market. Hopefully for them, they can make a great rebound and continue to kind of evolve technology as we move forward. As a real estate investor, I'm just going to be honest with you, I hope they completely implode. But that's just because they're my competition and they're beating us at our own game. So screw that. We want all the deals. And by the way, if you want my help getting a lot more deals so we can outmaneuver companies like Opendoor or any other iBuyer out there, down in the description down below is a bunch of free training, a bunch of courses, my best software, everything I use to dominate and make a lot of money as a creative real estate investor. Whether it's trying to learn the business, scale the business, automate the business, the links down below will help you do all of that. Look, these aren't easy videos to make. There's a lot of research that goes into them, so smash that like button. Do me a favor, share this video with other real estate investors. And yeah, that's all I got for you. I love you guys. Thank you for watching all the way to the end. I'm out of here. Until next time, take care, comb your hair, Sperber out.